Chris Jones from Sunbelt Business Advisors and True North M&A, back with the next video of our 24 rules for a successful business exit. If you like these videos, please like and subscribe. Today, we're digging into a topic that you've all been waiting for. It's one of the most misunderstood areas of business valuation. Earnings are the cornerstone for determining the sale price of your business. But did you notice that I said earnings? I didn't say profits. This leads us to rule number 9. Know how to calculate your company's true earning power. Now, an alternative title for this subject is, do you even know your EBITDA? Check out this clip.
Deer Valley.
Yeah, ski instructor.
So, Paulie tells me you're thinking of selling your father's business, the Chucky Chinelli.
Yeah, I think it's the best thing for Mom. And of course, Tony, there'd be a severance package for you.
Frankly, Jason, I don't think you should sell the business right now. There's a lot of potential buyers out there. Let me get out of the hospital, run the numbers, get you the best price.
No, Chinelli's offer seemed fair.
There's lots of things to take into account. You even know what your EBITDA is?
My what?
Earnings before interest, taxes, depreciation, and amortization. Gives the true picture of a company's profitability.
Jason, you let me handle this. I don't want to see you get hurt.
Like Paulie said, EBITDA is a common way to measure the true earning power of a business. If you retain only one thing from this video, I hope it's this. Never, ever just hand a buyer your corporate tax returns because they don't tell the whole story. That's because financial statements and tax returns focus on profit. EBITDA, on the other hand, is earnings before certain expenses. So we normalize or recast the financials to show EBITDA. Here's an example. In this example, the business shows $800,000 in net income on the tax return. But to calculate EBITDA, we find we should add back $100,000 in interest and $100,000 in depreciation expense. Now we have an EBITDA number of $1 million. At a 4-time multiple, that equals a price of $4 million. If we apply the same 4-time multiple to the $800,000 in net income, we'd of course get a much lower price of $3.2 million, leaving $800,000 on the table. You deduct every allowable expense according to the tax code. This is a fair way to mitigate taxes. But when it's time to sell, you are looking to do the opposite. You want to highlight the full earning power of your business. Recasting your financials generally leads to add-backs in 2 broad categories. First are add-backs for interest, depreciation, taxes, and amortization that were deducted as operating expenses. This is the EBITDA formula we've already talked about. Second, there are add-backs for personal, discretionary, and one-time expenses. These include things such as owner salary, family member wages, personal auto use, and many other things. Adding back an owner's salary is done when we expect the buyer will be an owner-operator. When we do this, we call the new number SDE, Seller's Discretionary Earnings. Here's an example. In this example, using a 3-time SDE multiple, the price would equal $1.5 million. Like EBITDA, we check interest, taxes, depreciation, amortization, and add them back if they exist. With SDE, we also add back that owner's salary and owner benefits. If we had stopped at EBITDA here, we would have had a $300,000 number. But this is a smaller business, so we believe the buyer is going to be an owner-operator. So we add back the current owner's salary and benefits. We also add back a one-time expense. This adds another $150,000, bringing the SDE up to $500,000. So we do some research and see SDE multiples average around 3 times for this business, giving us a probable selling price of $1.5 million. Now, if we applied that 3-time multiple to $200,000 in net income and made no adjustments, we'd be looking at the $600,000 price number. Look, these adjustments are not controversial. Buyers and banks readily accept them. So again, never, ever just hand a buyer your tax return. When one of our business brokers does a value range analysis for you, they'll help you calculate your EBITDA and SDE and tell you which is appropriate for your business to make sure you don't leave money on the table. Me and Paulie don't want to see you get hurt. I'll catch you in the next video.